Welcome, ladies and gentlemen, from me, Guy Monson, to our 6-minute strategy summary. I begin the session just recapping on the performance of world markets for the year to date. For a sterling investor, gold up to new highs, $1894, above even the levels we saw in September 2011. UK gilts broadly flat, world index equities grinding slowly higher to actually be up year to date for a sterling investor. Extraordinary given the COVID health and economic backdrop. On the right-hand chart, equity market volatility continuing its steady move downwards, but still at twice the levels, that VIX index at 26.1, that we saw pre the COVID crisis. But the real stars of the last few weeks, shown on slide 3, have been everything European. I plot on the left the US dollar euro rate since the 15th of May, the day when Chancellor Merkel and President Macron announced the formation, or the proposed formation, of the EU Recovery Fund, an extraordinary rally from 108 to 116. On the right-hand side, similar moves for world equity indices from that date. And you can see the MSCI Europe, that's European equities, actually leading global markets, leading even the NASDAQ index. Extraordinary for Europe, which is normally a laggard. Now, part of this reason is actually some good economic, also better economic numbers. The euro area composite PMI came out this morning, which gives you some measure of what businessmen are thinking about future conditions. That moved above the critical 50 mark to 54.8, well ahead of expectations, the highest in 5 months. Of note, interestingly, the UK number was also good at 57.1. But the real excitement on slide 5 was 4 nights and days of negotiations in Brussels around the formation of the EU Recovery Fund. This is one of 4 fiscal programs that Europe has introduced since the crisis. A new ESM facility, light on conditionality, relatively easy borrowing for states for healthcare matters, big, 2% of GDP, but still a stigma. Enhanced unemployment risk insurance, their SURE program, and big help from the EIB. But this was dwarfed by the 750 billion made available from the Recovery Fund. Critically, 390 billion euros of which comes in grants to the most challenged nations coming out of the crisis, which of course doesn't add to debt levels. So how significant is this? Does it mark a real step down the progress to fiscal union, and what are the financial consequences? Well, I think it is very significant because the grants, as I indicated, don't add to debt levels. There's a really significant increase in EU spending power. The cost and debt sustainability of the weaker countries like Italy or Spain is really improved by this. And most importantly of all, perhaps in the long term, we get a new risk-free asset, EU issued or European Commission bonds that can be used as a safe haven benchmark asset, rather as US treasuries are for much of the rest of the world. Add to these that, of course, there is already some fiscal union, transfers via budget, and already the ESM, and we are on a journey. Now, Jean Monnet, the founder, if you like, or the father figure of the European Commission, the founder or the key to establishing the European Coal and Steel Community, which was the predecessor of the EU, said Europe will be forged in a crisis. And this is again what seems to have happened. The impact for underlying economies on the right is quite significant. The EU modelling programme suggests that by 2024 we'll add more than 2% of GDP, almost 4% of GDP to the higher debt countries, and will help begin to bring down debt levels. But we're not there yet. Polls show that European citizens are still sceptical of a full fiscal union. The banking and capital markets union is by no means complete. COVID has opened up huge divides in north-south economic growth. And of course, there's still some polarization politically between the East and the West over some of Europe's liberal values. And those were an issue at the European Recovery Fund discussions. So what does this mean for policy? Well, for bonds, it's very exciting. I mentioned this new EU bond, a safe haven, a long-term alternative to US treasuries, perhaps. Importantly, issuance across the curve. Secondly, of course, the Recovery Fund supports the weaker members, So expect to see more Italian bonds in particular, but other peripheral bonds in global funds. Secondly, this should be good for European equities. Yes, Europe was already performing well during the crisis, and the assumption that Europe always fails in some way needs to be revisited. That's good for a re-rating of EU equities. Also, of course, some of the policy objectives of this fund, pro-growth investment, automation, digitization, and most importantly, the green agenda. Could this be a trigger to re-rate Europe from the traditional banks and cyclical equities we've always understood? It's good, of course, for the currency. This should attract flows into Europe and into EU-issued bonds. And fourthly, the spend from the whole programme on climate is hugely significant. It really makes Europe a world leader. That should be good for investors in EU climate-related equities, green bonds, and potentially climate infrastructure. Most importantly of all, though, it shows that social challenges are moulding the response of countries, of politicians, and of programmes like the EU Recovery Fund coming out of the COVID crisis. This is exciting for an ESG-focused investor like ourselves, who's looking at how we treat suppliers, customers, and most of all, a cohesive society, a driving force for the beginnings of a revolution that we saw in Europe last week.